Well, thank you very much, George, and thank you for the privilege of being in front of such a distinguished audience. Redeeming value. Bit intriguing, isn't it? What's it all about? We work on value. Do we have to be redeemed? Well, I want to use this short presentation here to emphasise what I bring to value investing. I'm an accountant. Now, before you go off for straight away to coffee break because of that, let me tell you I'm also a value investor, and my chief interest and research is how you handle accounting when you're doing value investing. We understand that the main aspect of it is understanding the business, really understanding the business. But that getting that understanding represented in some numbers, which are in dollars, is important because the price we're trading at is a dollar price. And so that's broadly what my interest is, okay? There's good accounting and there's bad accounting. There are traps. So I find this very fascinating, so I'm going to use this talk to lead you into that. Okay, and what I'm going to start with is what we all in this room recognise as simple value investing or too simple value investing. It's got a name called. By trading on price to book, it's called trading on value. And we understand that that's rather simplistic. It's worked well. You don't have to go to Columbia or Ivy or any other university to learn it. A fifth grader can do it. Find the price, the book value, and if you do, if you understand division, you're on your way, okay? It's in the history, it's documented as well, it works well, they say, back as far as the 1920s. Since the financial crisis, it hasn't worked well. Last couple of years, a little bit better. There's also an approach to investing called factor investing, Farmer and French being the high priests of it, okay? Which actually build a risk factor based on book to price. Now, here's an example, in my mind, of an appalling application of accounting. Now, don't get me wrong, Eugene Farmer was my professor at Columbia, so I admire him tremendously, at Chicago, so I admire him tremendously. But drag through the data, find that since 1920, book to price is predicted returns. Assume market efficiency, as the academics do, and you call that risk. It's sort of very primitive. So the question is here, what's going on here? Why have we got this? And to the theme of the talk, can we think about book to price? How should we think about book to price? The simple valuation in the context of a full value investing, which most people in this room are engaged in. That's the agenda. There's the quote from the man, okay? They talk about value versus growth. Sort of stupid. A growth stock can be a value stock, as we all know, okay? Now, we value investors have a creed, and part of that creed is ignore information at your peril. You're in danger. In trading just on one bit of information, book value, you're in danger of trading with someone who's done their homework. Like you people. Mm-hmm. Because a low price to book could be a very dangerous stock. And so here's a question for those simple value investors. If you're trading on price to book, shouldn't you understand the accounting for book value? What are you trading on? And it's not just satisfactory that it's worked in the past, because there are traps there, as the last 15 years have shown. Okay, so now we'll get into trying to develop this. Now, of course, I've got to understand accounting, the accounting for book value. One example of that is, hey, in the modern corporation, there's not many assets on the balance sheet, okay? So you have a high price to book just because they don't put the assets on the balance sheet. Instead, they actually expense them to the income statement. What's going on here? You're in danger of falling into a trap if you don't understand that. Okay, so, but also we need to understand how we might price book value. And to do that, I'm going to introduce, I'm an academic, so I have models, okay? Models, in my mind, valuation models are not very good. You shouldn't use them, but they give you a way of thinking. When I say you shouldn't use them, you shouldn't just plug in and think that value is going to come out on the left-hand side, okay? They're a way of thinking. And here's a way of thinking. This is a valuation model, sometimes called the residual income model, which many of you are familiar with, I hope. It's equivalent to the discounted cash flow model for very long forecast horizons, but it's got book value in it. Okay? And it says, listen, start with the book value, that's price on the first element of the model, and then add the projected value added to book value after covering your cost of capital or required return on your investment in your book value. The short form of the model is here. It's just forward earnings, and then the remainder of the history, which for a going concern is a very long time, represented by a growth rate. Okay? It can be restated in terms of book value plus the return on book value greater than required return. So it tells you, if in fact you forecast that the return on book value, ROE, is going to be greater than required return, it must be worth more than book value. That's the starting point. But it also tells you, yeah, then you've got to think about the growth. Dividing through by book value in the third line of the equation gives you the price to book ratio, which of course is the focus of the simple or too simple value investors. Now, here's an interesting expression. Let me take the book to price. I'm going to use book to price because they often talk about book to price rather than price to book. Let me add the ROE. And when I take the book to price and multiply by the ROE, the book value drops out. At least it did when I went to school. I think it still does. And I get earnings to price. Here's a very important thing to recognise the properties of one of the properties of accounting. You can't think about book to price without thinking about the return on the book value, the earnings that the book value is going to earn. And when you do, book value becomes irrelevant. It's earnings to price, which is another metric on which so-called simple value investors trade. Actually, this also has another point that is not in the slides, but there's something for us to recognise as value investors. We value investors say we buy firms with good profitability, high profitability. But it turns out that can be a mistake, because a firm has high profitability just because the assets are not on the balance sheet. It's not real profitability, just because the assets are on the balance sheet. No, you cannot look at profitability without carrying book value with you. Very important accounting principle, very important value investing principle. Okay, so now, well, book to price drops out. So are they doing nothing? Is there nothing here? Here's an example. Here's Microsoft, the end of June, which is its fiscal year end in 2025. I got the calculation there. We're short on time. I'm not going to go through it, but it shows that, as you go through, if you do the multiplication with the forward earnings and the book value, you get a forward earnings to price of 3.04%. Now, let's then say, oh, there's assets missing from the balance sheet. Let's put those assets on the balance sheet. Well, an example here is 400 billion. Let me put on the balance sheet. What happens? I go through the same calculation and I get the same earnings to price. It doesn't matter whether the book value is on the balance sheet or not if you're focusing on the earnings to price. Okay, so is there no redemption for book to price? Well, we've got two things here. First of all, you can't use book value without the earnings to price, with the earnings that the book value is produced. But when you do, the book value drops out. Is book value to price, a book to price, then irrelevant? No, there's something else in that formula. It's the growth into the future. And we value investors know growth is the difficult thing to get the handle on, the pricing of growth. We can see the book value. We can see pretty confidently the forward return on equity. It's the growth that's our big problem, okay? And we see now the book to price actually involves growth also. So the question before us now is whether book to price or price to book can actually give us some handle in terms of assessing the growth. And so now I'm going to go into the mode that I go into when I do value investing. As I said before, I don't think valuation formulas are very helpful. What is that growth rate is very speculative. And it's the growth rate in the market price that we're trying to get hold of. There's a lovely quote from Charlie Munger. It says, in business schools, they teach this idea of forecasting the future, putting in a growth rate, discounting back, and pretend they get the price. He says it's stupid. He says, well, in business schools, they've got to do something. So, in typical Charlie Munger mode. Anyway, so the way I think about value investing is as follows: rather than thinking that we can actually forecast, put in growth and speculate about growth and get the price, along the course with our hurdle rate, our required return R, turn it around. Understand that the speculative part of the price, which we're trying to challenge, is in fact the growth rate. Rather than doing the valuation, put the market price on the left-hand side and calculate the growth, the pricing of growth, that the pricing that the market is putting on growth. What is the growth rate implicit in the market price? This is your standard reverse engineering, which is often brought to getting the expected return from investing, but now it's focusing on, I am asking, I'm not getting a growth rate and pretending I can hold it and get the price there. First of all, I'm asking, what is the growth rate in the market price? And I think this is the mentality we need to, as value investors. After all, value investing is not a game against nature. Going out, we talk about price and value, we talk about intrinsic value. In my mind, it's best to think there's no such thing. You don't have to go out and find it. No, the game is not a game against nature, it's a game against other investors. What are other investors thinking? What's the growth in the market price? Are they those rational investors who actually develop a price which we cannot agree with? Okay. After we do our value investing analysis, in my mind, this is the way to do it. We don't have to. We're trading against other investors, and all we have to understand is what they think about this speculative aspect of the market price, the growth rate. So with that orientation, of course, this was as a name, of course, given to Ben Graham, okay? He called it negotiating with Mr. Market. What do you think, Mr. Market? And do I agree with you? Reverse engineering the formula here, I get a growth rate. In the market price. Now remember, the P here is not the for the value, it's the market's price, what the market is thinking. And I get a growth rate, which is simply the hurdle rate, your hurdle rate for investing, yield relative to the yield, the earnings yield, over 1 minus the book to price. Book to price comes in. So I needed the book to price. Let's say book to price now is redeemed, but not as a simple screen, not as a simple screen to say I'm going to buy high book to price and sell low book to price. As a screen, along with the earnings, which are always in a double entry system produced with book value, as a screen to understand how the market's thinking. And then I can proceed, to with my analysis. Well, do I agree with Mr. Market? Or has he got it wrong? Or does he know something that I don't know? And so on and so forth. Okay, so at Microsoft, this is at the end of fiscal year 2025, June. The G for a 10% required return, if that's your hurdle rate, the growth rate is 7.62. That may seem as a bit ambitious. This is growth and value added. If the hurdle rate is 8%, it's 5.3%. And of course, it changes because the higher your hurdle rate, the more growth you need to cover your cost of capital. Last night at close, I went back to Microsoft, observed the price. It's down 22% since June of 25. Now that growth rate with a 10% required return is 8.61%, or with an 8% hurdle rate is 12.04. That's looking better. I'm tracking Microsoft, you see. I'm tracking how it thinks. Oh, it's dropped 22%. Hey, now is that a growth rate which actually I think it can achieve and which I can invest in? Now there's another way I can do this. Another alternative reverse engineering. I can now, rather than reverse engineering that simple model to G, the growth rate, I can reverse engineering to R. Okay? Again, by putting in the market price. There is simply, however, there's a subtle change here. R is not the required return, your hurdle rate. R is the expected return from buying at the market price. If the market price is too low, you're going to get a higher expected return. If it's very high, you're going to get a low expected return. What's my expected return from buying at the market price? And here's the formula. And very interestingly, book to price comes into again. Book to price is redeemed. And what we have is, it's a simple, the formula says, it's just a weighted average of the return on equity and the growth rate, okay, that you can see. Book to price is now not something to trade off, it's a weight to apply to the ROE component of the valuation and of the growth rate. But of course, that first in that first brackets there, parentheses there, that's just earnings to price. So we can think about buying the earnings yield and then adjusting that, because in the earnings yield affects the earnings yield or the PE ratio. So a modification of that, we modify that by the book to price. In Microsoft, back there in June of 2025, the earnings yield was only 3.04%. I get, and the price to book to price was very, very low, 0.087. I get 6.69. Well, the Treasury yield at the time was, 10-year yield was 4%. That's not a lot of premium. Mm-hmm. So I might say, not today, Mrs. Murphy. I'm not going for it. Now, put an 8%, which is very ambitious, is 10.34%. But even with a very ambitious growth put in there, I only get 10.34%. Well, it's 6% premium over the market. Now remember, these are not just what I'm going to get next year. These are sort of yield to maturity calculations, just as a bond. I'm just applying the technology to get the yield to maturity for a bond to an equity. There's no maturity, of course, but I'm thinking about the very long run. Okay, now, so I've given you two tools here, which actually redeem book to price and include book to price. Now, I haven't got very far. But I'm suggesting to you that if you're thinking about screening stocks on those where you're going to go and do your homework, these might be useful screens to start with. They're not the answer, because you're only using 2 bits of information, earnings and book value. But this is a better screen saying, well, let me look at the high book to price stocks. No, I had 1 bit of information, and I get, I believe, and I know from research and experience, a much more powerful tool in terms of understanding what ones I want to particularly look at. Okay, now I've got some applications here, so I'm going to go through very quickly. Here's some annual returns from trading on earnings to price. Across these portfolios, I've got 5 portfolios. The portfolio number 1 is negative EPs, and the rest are positive. If I go long on the high EPs and the short on the low positive EPs, I get a spread of 9.1%, of course, which is zero net investing with transaction costs. So that's EP giving you something, okay? But I shouldn't be looking at earnings without looking at the book value. If, in fact, I actually add the book value for a given EP at each of those portfolios across the rows, I go down the columns and I rank on book to price, hey, I do very quite better. This is just in the history, okay? This is just in the history. So there you see seeing earnings to price and book to price together, you improve returns tremendously, okay? And if, in fact, I take a position now on the stocks with a high book to price and high earnings to price versus those with low earnings to price and low book to price, the spread there is in that red number, 14.7% from that position. So in the history, that looks like quite promising, okay? Which gives you a sense, if you take this as a starting point for your value investing, now I'm going to investigate these stocks, okay, to see whether, in fact, these are the ones I want to buy. Now, of course, you're going to add a lot more information. You're going to understand the business. You're going to bring other accounting information. You're going to bring a lot more into it. But now you have a starting point, which actually looks quite promising, a screen to actually start to work with. Okay. If I want to plot the cumulative returns to earnings to price and book to price, there you have it. The green is using them with quite a bit of volatility and a big drop, of course, in 2008 and 2009, and also in 2022. I'm going quickly here now because he's going to jump on me in a minute. Does it work every year? No, there's risk. Okay, and here are the recent years. 2008, where the stock, the S&P 500 was down by 37%. That corner would have the strategy would have delivered you negative returns, as would the long short strategy, and so on for other years. That says, hey, ignore information at your peril. Now start thinking about whether you just want to do this simply, which maybe not a 5th grader, but maybe a 6th grader could do. I want to use this as a starting point to actually do my homework. Here's some applications, very quickly. S&P 500 from 1982 to 2024. Here's my expected return formula. I can get the forward earnings to price for the S&P 500. I can get the book to price at the end of each December 31st each year. If I get the correlation between the expected return and the subsequent realised return for 1 year ahead returns, it's 25.7% correlation, 0.257. my expected return has a correlation with the subsequent next year's realised returns of 0.257. And it increases. I look at 2 years, 3-year returns predicting, okay? And that gives you some sense that maybe there's something here that's discriminating. There's a graph here that plots it each year. We can't look at that. We look at the growth rate each year. We can do exactly the same calculation. Individual stocks, which of course we're more interested in. But by the way, even you're a passive investor and you're just buying the index, you might want to ask yourself, is this the time to go into the index or get out of the index? And so now I have a simple screen, this expected return on the S&P 500, which actually just brings 2 bits of accounting information that says, well, maybe it's a bit high, okay, or the expected return is low at the moment. I'll get out and I'll go back into it. It's you call that sort of quasi-active passive investing on the index. Individual stocks. Now, here what I've done every year. This is all US stocks, traded US stocks, or most of them, since 1963 to 2023. If now I calculate this implied G, and every year I rank them on this applied G, okay? The market's view of growth. And rank them into 10 portfolios. In the bottom 2 portfolios, the market's seeing negative growth. In the top portfolios, there's very high growth. I rank them. Here's the earnings to price, the book price, but here are the 1-year returns, the 2-year returns, and the 3-year returns. It ranks the returns. That's quite impressive. Don't let anyone tell you the accounting is not informative. Now, by the way, I'm just using the accounting the GAAP or IFRS throws out at me, okay? I do have to watch out because there are problems there, okay? But here I'm just crudely using what they throw out at me. And that's really giving me something. Okay, now am I done? Well, hold it. There's risk in this. There's a distribution of turns over 2 years from doing this. And yes, there are some negatives, and there's a couple of quite big hits too, okay? So this is a risk. But on average, it has done very well for you. I'm not promoting this as a trading strategy. Definitely not. All I want to get across is this is a way of starting thinking about your value investing. There's to help you screen what stocks I might look at. The growth formula and the expected return formula. These are not random numbers with error terms on. These are deterministic formulas using the accounting. This is how it works. Nice thing about accounting, it works in a system which is deterministic and a set of rules. But we only have 2 pieces of information. But this is where full value investing starts. Okay, book to price is redeemed only in conjunction with earnings to price, because it gives you some information along with earnings to price about the expected growth, the market's growth rate, or the expected return from buying at the market price. With just 2 pieces of information. Now go and do your homework. Understand the business. Understand other aspects of the accounting. Understanding the traps in GAAP accounting or IFRS accounting. It's just the way I think about it. Thank you for your attention.